So the following episode is all about catching beaten down stocks. Are you looking for deal opportunities, or maybe it's just too risky? Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique, and I have a feeling, Véro, that we're gonna have a lot of fun today because we already having a lot of laugh right before clicking on record. So I think it's going to be a great episode.
Well, I mean, most listeners know that, but maybe some don't. We've known each other for like ever. So
Literally.
of course it creates fun discussions almost daily, I would say. So it should be fun. It should be fun. So Mike, we keep on saying that we are in a bull market for way too long, but there are stocks trading at their 52-week low. We selected 8 of them today, which are, I would say, real buying opportunity, not necessarily dividend traps losing market's favor, because I've looked at DSR and they're well rated, right?
Yeah, but I wouldn't go too fast on saying they're just great deals or great opportunities. I mean, there are some good reasons, though, why they are so down. And this is what we are going to try to domesticate here, where you have on one side, it looks like a great opportunity because it's trading at like all-time low or like 52 weeks low. But on the other side, there must be a reason. I mean, there are not that many investors that are completely stupid and just selling their shares. It's hard sometimes to find the balance. And a few stocks out of this list, actually, it's kind of like not a slam dunk at all. But of course, if there's a rebound, it's going to be great investments.
So I see that you kept some surprises for me today. And before we start, listeners, remember not to consider the ideas we will mention today as buy or sell recommendations. You must always do your due diligence, so don't consider only the ratings like I did before buying or selling any security. So Mike, it's important to mention that you personally never buy on price weakness only. So today's goal is to highlight quality companies that are facing headwinds, or maybe just simply offering a good entry point, right?
Yeah, I'm not a big fan of trading on like either price weakness, or actually, I don't mind buying stocks at a all-time high. For me, it's just like price is a data point, and we have this data point in a context where we look at the past year or the past 5 years. But it doesn't mean much because the stock could go back up or could continue to go down moving forward. We don't have this kind of information, and this is what I wanted to highlight among those stocks today, is just to say, well, it's not 8 companies that will double in value and fully recover in the next 3 years. It's probably that some of them will continue to be dogs for a long while or never recover also. So you have to be careful about price movements. And again, on the ratings, before we move on to the stocks, one thing that's interesting is always about that perception. So, sometimes you're going to find a stock that has a great rating because the person or the firm behind the rating believes that it is a good entry point and it has a lot of potential. But at the same time, if that person is wrong, well, of course, the stock's going to continue to go down. Last year, we did an episode on ratings from Morningstar, for example. And then Morningstar back then rated BCE like a 5-star, like an amazing pick before the dividend cut, after the dividend cut. But their rating it's all based on their valuation model. If they see a stock trading at $20, but they value it at 30, well, it becomes 5-star rating. But what if it never goes to $30? Well, then it's just a rating that has been wasted. And it's completely normal. It's all about perception at this point and where the company is going forward. So I believe those 8 companies can actually turn things around and become great again. But we'll see how it goes after that.
So Mike, when or why do you look at 50-week we close then?
Well, technically, it could be a good entry point. I would say that when I run my stock screener looking for companies with a strong dividend triangle first, so metrics such as revenue growth, earnings growth, and dividend growth, well, then I see a thriving company or a company that did well over the past 5 years. And then if you look at the stock price going the other way around, so the opposite direction, well, then of course, you must investigate to understand what's happening. There's definitely a negative sentiment, so you need to understand why. But then you could be in a good place where you have a negative narrative, but you have very robust metrics. So if you know the business well, you know the sector well, you're in a better position to understand if the narrative is just fear being spread, because that happens a lot as well, or if it's justified. So this is something interesting when you have done the rest of your analysis. Of course, if I look at 2 or 3 stocks at the end, and then one of them shows like weaker P ratio than usual and some like price weakness, of course, it's going to sound like a better deal, but you have to be careful to not fall into the price anchor bias either. It's not because a stock once traded at $100 that it's going to get back there anytime soon or ever. I mean, still waiting for Nortel and BlackBerry and a lot of those companies, right, to come back to their levels. So it's not always the case.
Okay, so let's start with 2 ideas in a sector that we don't often discuss, healthcare. So we have United Health Group, UNH, and Zoetis. I'm not sure how to pronounce it. The ticker is...
I'm not sure either, so don't worry about it.
Yeah.
We'll let listeners decide for us.
It's ZTS. All right. So they both show a strong dividend triangle so far, like you've mentioned, revenue, EPS, and dividend growth over 5 years. What's your investment thesis for both?
Yeah. So for this episode, just to put listeners in context, we're going to start with what we like about the stock. And of course, after that, we're going to explain why the stock is down. So don't just listen to the first part, also listen to the second part, because I mean, you're going to be convinced that I really like United Healthcare and Zoetis once I'm done with this part, but there are some risk and downsides as well coming up. So UNH, well, it's the largest private healthcare insurance in the US. It operates to 2 main businesses. So you have Optum and United Healthcare. So what I like about this company is it is vertically integrated. So they are there at each steps where they provide the insurance, but they also provide the care. So they can make money at every single step of the insurance or the care that they provide. And one thing that is really important for the follow-up on what's going wrong here is because they are offering government-sponsored care to the Medicare Advantage, they receive money from the government and then they provide cares to seniors. And the play here is to receive as much money as possible from the government, provide the care, but at the lowest cost possible, so you can make the spread between both, right? And the more the government give you money, the happier you are, and you just have to manage the cost of care. So as long as you're good at doing this, and UNH has been stellar doing that for more than 10 years, like reporting earnings per share growth by 10% or more year after year until last year, where a lot of problems happened. But before that, the dividend triangle was absolutely perfect. So looks like a great story. Now we're going to take a look at what went wrong in a second. But let's take a look at Zoetis as well. Clear leader, but for animal health this time. So we're talking about, and it's kind of funny because you have more animals than I do because you have like you have like dog, cat. You have a zoo, a horse, chicken. I only have 2 dogs, but I mean, we can notice this company because they are selling a lot of like vaccines and diagnostic and a lot of things that whenever you go to the vet and the vet is giving you something for your animal, chances are there's a Zoetis logo on the back of thing because they're the leader. So what is great is they operate in a fragmented market and they're the largest and the biggest player. So they get a lot of money. It's a lot of repetitive purchases. Once you convince vets to use your products, they're likely not going to shop around. They're just going to continue to prescribe the same thing. They offer some medicines and drugs to all kind of pets as well. So you have like farm animals, but you also have like dogs and cats. So they're pretty much everywhere and they're growing relatively fast these days also. So, and we know how much love we give to our pets. So whenever they are sick or they have a problem, them, well, we are willing to pay for them. And like, this is where the money is for Zoetis. So two great companies, leaders in their market, showing great metrics yet. So there's no reason why they would go down, right?
Right. So then how would you explain their price weakness, Mike?
Yeah, seriously. I mean, United Healthcare, we covered it last year for a few times. It's a big company in the US, and it went into possibly like the most perfect of the perfect storms. I mean, they got hacked. They got like one of their president getting shot. And then it keeps on piling up with bad news and then more bad news. And they couldn't control costs for providing their healthcare. As I was explaining before, they lost control of some of that last year. And then earlier in January of 2026, they reported their earnings, which they were okay. Like the latest quarter were okay. But there was a big news that was just announced at the same time. And it's the Centers for Medicare and Medicaid Services, the CMS. Those are the regulators to increase like the payments they give to healthcare companies to provide Medicare advantages. And it's a big program. We have like over 35 million seniors in the US that relies on Medicare Advantage. And then again, the name of the game for UNH is to get that money from the CMS and then provide the services, but reduce the cost as much as possible to get good margin on it. So to give you a perspective, in 26 this year, the rate has increased by 5%. And then for a decade, UNH has been making a ton of money doing this and getting like more rate increase all the time. But for the following year, and that was the news that was about for 2027, the rate increase will be 0.09%. So might as well just not even talk about a rate increase. I mean, how would you feel about that, Vero? I'm going to give you a pay raise of 0.09%. It's probably like a cent or 2 cents per hour. I don't know.
With the inflation, I mean, it doesn't make sense. So like you said, 5% on one side and then not even 1.1 on the other.
Nothing on the others. You bring a very good point. While the rate increase has dramatically stopped, well, cost for UNH last year to provide services has increased a lot. Of course, due to inflation and also due to the fact that a lot of seniors need more and more cares. Well, therefore, you need to provide more services. And if you're getting like the same amount of money, that doesn't add up. So now they are facing a very tough problem where they don't have much control over because, I mean, they're just not going to get the size of the check they expected. So they have to review their guidance. And I kind of have like a mixed feelings right now. In this industry, they are really well positioned to come out of this storm as the survivor. Like let's just not say the winner, but the biggest survivor. So if it happens, they may end up getting even more business and grow even faster going down the road. But it's still a gamble because with all bad news and bad sentiment that happen around UNH, it's gonna take a long while before investors come back. So now they have to digest a long pile of bad news that are not just, I mean, sentiment at this point. It's literally going to affect UNH margin going forward. So as long as we have this politics trying to reduce costs for healthcare, UNH is going to be in big trouble going forward. It's not going to be a bad business that's going bankrupt, but it's going to be hard to, I mean, investors are used to see double-digit growth across the board. Likely not going to happen in 2027 with the numbers so that's why the stock took another hit. So on this one, I have a little bit of mixed feeling. It could be a great play over the long run if you're patient enough and they can turn that corner, but it's a pretty big corner turn. So not too sure. And full disclaimer, I don't have any shares on this one. No intention on making this play. I think the risk reward is there on both sides. So high risk, high reward type of thing. Right. For this in 2025, last year, they got it by a 2-punch. So they revised their sales guidance. Of course, when you do that, market doesn't like it because they project numbers and their assumptions are now completely wrong. So that's a bad thing. And on top of that, we had a viral campaign about like safety headlines on some of their blockbuster drugs, not really helping pets, actually quite the opposite. So there's, I mean, we all know that now that when it goes viral on social media, you have like a lot of vets saying that they're not going to use that drug anymore. So of course, sales plummeted and now they have to fight back. Zoetis is saying, of course, that it's not not happening for real. It's isolated cases, kind of like the classic that we see sometimes with big pharmaceutical for human. Now we see it for
Right.
pets, but it's pretty much the same story. So again, we are in a place where, I mean, I find this stock as an interesting play, but I'm definitely not aware of all the like FDA rules and labelings around all of those drugs.
Mm-hmm.
It's not an industry that I'm an expert in, but I would love to know more about it because I find it could be quite interesting to enter in a play. We have seen in the past that sometimes those news are making a lot of noise and then it's not the end of the world. I can think of Johnson Johnson around
Mm-hmm.
2012 with Tylenols. They had to call back so many bottles because there were I can't remember what was the story, but long story short, they had to make a major recall, cost billions of dollars, a lot of bad press, of course. And I mean, fast forward 15 years later, Johnson Johnson's still there, up and thriving, making a lot of money and increasing its dividend throughout this entire time. So sometimes if you're patient and you can go through the noise, well, this is the kind of play that could be interesting, but I don't have the level of knowledge to say if it's complete BS or if it's actually a real problem that they're facing.
Right. Okay, so the information technology sector has also made a few like price victims lately. One of your holdings, Mike, is part of the group. So why do you hold Constellation Software? Let's start with that.
Yeah, this one has been quite a debacle. I mean, the stock has been down by like 50% like over the past 8 months or so since the summer of 2025, but it keeps going down. So, I mean, I covered it on the Moose on the Loose a few times. I'm going to continue to cover it because, of course, as you said, it's one of my holding. A good chunk as well, a full position. What I like about Constellation Software is actually, I have to like it a lot because I made an exception to my investment rules because Constellation Software is not a dividend grower. I always joke that one day someone on the board had a quarterly dollar of dividend per share, and then it got buried in the notes and no one ever looked at it ever. Because I mean, they've been paying $1 every quarter for like a long while, never increased it. So it's kind of like insignificant. At one point when the stock was hot and trading around $5,000, the yield was like almost as big as the CMS increase. So like 0.1% or something like that was like not even something that you can notice. So Constellation Software, what I love about it is they evolve in a very niche industry. They are acquiring small businesses that specialize on having a vertical software. So a vertical software is like for a specific industry. So think about you have like, I don't know, like a car dealership. You need like specific software to run your business. And then of course, those businesses, they know exactly that market. So they know exactly what are your needs. They tailor the software to your needs. And then they kind of like, they get capped to how much they can make. So eventually at one point, they are interested in selling. And Constellation Software comes in, buying those small deals, but they have a process where they can do that hundreds of times per year. So they have like a very big team in acquisition. They do that in all kind of verticals, but they're super niche. They often comes as the only buyer, so they can make great deals. And if you look at the cash flow from operation and the free cash flow for this business, it's constantly going up. So it's a money making machine. And of course, the reason why they don't increase their dividend is because they use their capital to make those acquisitions. So kind of like the perfect business model once you have the playbook written down and everybody's following along. So great expertise, been doing that for decades, great success here.
Okay, and then we have, listeners, we will go back to the reasons why it's down in a few minutes, but we also have Roper Technologies, which has a business model, I would say similar to Constellation Software, right?
Yeah, definitely. I mean, if you want to buy a US Constellation Software, you can go with Roper. It's pretty much the same thing. I mean, asset light, cash focused business. They're buying also companies that offer software for verticals. So very, very similar. They try to balance their acquisition between fast growing software and also mature engineered products businesses that generates a little bit more cash flow. Again, we're talking about mission critical solutions in like very niche sectors such as like healthcare, insurance, legal, public sector, logistics. They have high margins. It is quite sticky. I mean, I can just think about all the software that I use for DSR. I mean, we do webinars, for example. I mean, I've been using the same webinar service for, I don't know, 10 years now, almost. Yeah, I don't know. I've used
I can't remember, but it's been a long time.
Yeah, I've used two platforms in the entire
Right.
time. And the only reason why I switched from one to another is because the first platform went through a lot of technical issues, and that happened in the middle of one of my webinar. So I got quite upset because it's a really important part of my business. So you can see it's exactly the same thing that Roper and Constellation software does. I don't pay like a fortune to have access to this software, but I need it to run my business. So I'm not going to change as long as it runs smoothly. And every year they increase the subscription that I have to pay, and I gladly pay it because it's part of my business. It's not significant, but it's a critical part. So this is exactly the type of business that the Roper and Constellation software could be buying. I mean, depending on the size, of course, but just to say super sticky, repeatable business, subscription model. There's a lot of things to like about this type of business model.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. You know, our goal is to help more investors just like you, so please spread the love. Thank you. Okay, now another tech stock showing a 52-week low is Salesforce, CRM. People were talking about this one so much. Like, I think it was more in 2024 or something like that. But I mean, it was really, really trendy not so long ago. And it's still a new dividend payer. So what's to like about it?
Yeah, so Salesforce, they actually started to pay a dividend in 24, if I remember correctly, and then increased it for the first time in 25. So, I mean, company that shows a great dividend triangle, but did not pay a dividend as of late. Now they're getting there. So in 5 years from now, probably that we're going to have like the perfect triangle where you have revenue increasing, dividend increasing, and earnings increasing. Salesforce is the world's largest CRM. So kind of like the ticker for that. So CRM stands for Customer Relationship Management. So again, when you think about it, subscription, recurring revenue, sticky business model, they are growing by acquisition as well. So they expand their product offering to their existing client, but they're also acquiring new clients where they can offer their existing products. So you have like a lot of cross-selling opportunities between both when you do that. And when you're well established among like big leaders and big companies, you're kind of like the go-to software for a lot of new businesses as well coming up. So again, we have a similar type of business model. I mean, Salesforce is not acquiring, but they are in the software as a service model, the SaaS. And they're, as of until recently, those are the type of businesses that, and even personally, I love. And we even did a full episode on that probably like 2 years ago. But there's a lot of great SaaS businesses. And this is what we like. I mean, predictable revenue, a lot of cash flow, subscription, sticky business model, nothing to hate. So what's going on here?
So you're right, Mike. In these three cases, is the price drop like a sector problem or something related to the company?
Definitely, SaaS business model is under attack. And this attack is coming from artificial intelligence. There is this narrative where AI is going to disrupt the entire model. In a sense where, imagine going back to that webinar example, imagine now that I can use Claude Code or ChatGPT or Gemini and just say, hey, I'm going to create my own webinar platform with AI and I'm going to spend 10 hours on that. I'm going to have an amazing software and I will not need to pay for a subscription ever. And this is kind of like, I'm simplifying a bit, but this is pretty much the narrative here where a lot of people think that you can use AI and replace all kind of piece of code that you need for your software and be good with that. So therefore, a lot of people are thinking, well, the past revenue growth and profit growth will stop. I mean, it's going to hit a plateau and then it's going to reverse back and then it's going to go down. Personally, this is an area where I dabble a lot. I mean, I run an online business. I do a lot of businesses with those SaaS businesses, and I also use a lot of AI. And I was talking with our web developer that has been with us for the past 6 years now. And I asked him, I'm like, okay, so are you getting challenged by your clients? Are you losing business? Because, I mean, this is what they do. They just code, they build platforms for their clients, right? Our entire DSR platform has been built by those guys. And what he told me was enlightening. He said, at first, yes, people are just like, yeah, I'm going to code by myself. I'm using AI. It's all good. And then after a couple of months, they come back because they don't have the level of knowledge knowledge and expertise to build the right code, and they rely solely on AI, which comes with a lot more problems. And eventually they have like bigger questions that AI cannot solve because they cannot help AI to move past those problems or guide the AI to find the solutions in the code. And therefore, this is where this guy is coming back in, showing his expertise. And this has been also my personal experience where if I don't know a topic, when I chat with AI, I get basic answer that look very smart, but if I start digging, it's not that great. Once I use it for specific topics that I have an expertise and I have knowledge, I can enhance my capacity using AI, which is completely different. So for example, instead of going through 100 pages of financial statements, I can ask AI where I want to look, which kind of calculation I want to make. And then once I get the information, I can double check and then I can challenge to ask more questions to dig even deeper. It just does what I am able to do. But instead of me spending 5 hours doing the calculation by myself, it takes 15 minutes. But I could not ask the second and third layer of questions and really get to the bottom of my question, my original question, if I don't have my expertise. And it's the same thing with software and SaaS, where if you don't know the business, you don't know all the coding, yes, you can do a good job with AI, but eventually you're going to hit a wall and you'll need experts. When we look at the numbers now, the numbers are still great in 2025. They were great. I mean, Constellation Software, last time they reported earnings, revenue was up 16%, earnings per share was up 28%. Roper in January of 2026 was less than the analysts expected, but still revenue was up 9.67 and earnings per share was up 8%. So we're not necessarily talking about a company that is actually going down right now. It's still growing high single digit. And for Salesforce, they just reported their latest quarter. So I did not have time right before the episode to look at it. But the last one in 2025 was the same thing. Revenue was up by 9%, earnings per share was up 35%. So the narrative is something that we think it's going to happen, but it's not being backed by numbers right now. We do not see it that much. Yes, sometimes we have like revised guidance, but it's still high single digit to double digit growth, which I mean, as an investor, I'm happy with that. So not too sure that those companies will likely thrive and actually use AI to enhance their services and their profitability going forward.
Okay, so let's also have a look at Thomson Reuters. I'm not sure again, but anyway, you know what I mean. So the ticker is TRI.TO. And what is funny is it is classified as an industrial company, but actually operating with technology businesses, that's for sure, right?
Yeah, actually, Thomson Reuters, it's another SaaS, like plain and simple. So sometimes it's not even obvious why it's classified in the industrial sector. I mean, they provide information, but they do that through subscription. So they provide that to law firms, accounting firms, and corporations. So really another sticky business model that goes through subscription. More than 80% of the revenue is subscription based. So very recurring, predictable. The revenue is constantly going up. The earnings per share over the past 2 years are stagnating though, which is a bad sign. And that reminds me, we did a private workshop for DSR members on how to analyze your portfolio and diagnose like the weaknesses. And I use Thomson Reuters as an example of like, how can you spot weaknesses in your portfolio back then? And that was one of the things that came out as always strange. When you see a company growing their revenue, but not their earnings, there's a problem. Like it costs more, there's a margin issue here. And then you have to determine if it's like for long-term or forever. But I mean, this company has been very long-term dividend grower in Canada, one of the longest streak that is active among public company. The business is typically growing mid-single digits, so 5-6% every year. So incredibly stable. And there's a good, I mean, most investors will pay a good price for such a quality business. And this is probably why it comes such as a surprise why Thomson Reuters is going down so fast. That problem started like last summer in 2025.
And is its price weakness also explained by the same reasons as the previous tech stocks that we've mentioned?
Definitely there are a lot of concern about all the SaaS businesses. And I mean, we decided to select 4, but the list is very long right now.
Right.
There are a lot of companies that investors are not too sure about because of that. They think that AI is going to go through them and disrupt the entire model. The other thing is back in summer of 25, Thomson Reuters was trading at a P around, I think, 40. So when you trade 40 times their earnings, you better come up with robust results all the
Mm,
time. I mean, this is what we call price for perfection. So you have absolutely no room for a bad quarter. And they had some. So that was the problem.
right.
At this level, right now, the forward P is around 21. So it's a lot more reasonable. So at this level, I would be interested to consider Thomson Reuters at one point. But the big problem for me is the big issue is like where the growth is going to come from. Yes, those firms are going to continue to subscribe to their services and pay and can increase your subscription fees without any problem because it's a sticky business model, but you're not going to increase it by like 15% per year. So, I mean, you can expect to grow 4, 5, 6% maybe. So, was it enough to convince people to pay 40 times earnings? That I highly doubt. At 20 times, maybe it's kind of making sense a little bit more because I see this company as something very stable, but not necessarily a business that is going to grow very fast moving forward. So that's why you need some kind of discount to convince me to get in.
All right. And by the way, listeners, I will put the link in the show notes to our recent episode on AI businesses that should be bubble proof. Let's put it that way. So if you want to still invest in AI stocks without going into too much uncertainties, these could be great options. And the link to the show notes is always in the description of our podcast. Just scroll down a bit and you'll find it. All right. Moving on to the financial sector now, Mike. Two good companies are currently showing a good entry point. We have Brookfield Asset Management, BAM.TO, and GoEasy. Their business models are very different though. So what's your thesis on each?
Yeah, we're talking about like two different industries altogether, even though they are in the same sector. So for BAM, we have discussed it a few times because Brookfield is a major player in Canada. So BAM is the asset light manager. So their business model is super simple. They gather funds from retail investors, so like such as you and I, and from institutional investors. So think about like big investment firms, mutual funds, ETFs, pension plan managers as well. And they gather all that money and then they invest it. So they create private funds. They are specialized in long-term assets such as like toll roads, railroads, power plants, renewable energy. So all the things that are not necessarily super liquid when you invest. That's why we call them like long-term assets or alternative asset. But they are going to generate, usually the target is like inflation plus 5%. So like a 8%, sometimes 10% growth rate forward. So very interesting way of investing, especially when you have an expert like BAM that is managing the portfolio. And this business has been for a while. I mean, the Brookfield business is quite complex, and this is the main downside of it. That has nothing to do though with the stock price drop right now. But the biggest risk is you have to accept that you'll have to rely on management and accept that part of your investment is a black box. Some investors don't like that. That's totally fine. It's a good reason not to invest in Brookfield. But I personally like it. I do have Brookfield Corporation, BN. It owns 75% of BAM, but I do not have BAM in my portfolio. For GoEasy now, this one, very interesting when the economy is doing well because it's a smaller firm lending. So doing like classic furniture, car loans, mortgages, could call that they are lending money to B clients, not A clients. So clients that are not getting their financing from the classic bank because they had a little problem, they're maybe too much in debt, or there's something that is not perfect with their credit bureau or their credit application. Well, they go to GoEasy. They have a very strong underwriting process and they have been able to grow their loan book very fast, even faster these days. So definitely an interesting smaller type of bank if you want that could be exciting to own in your portfolio.
So now what explains their low prices?
For BAM, I'm not sure, honestly, because the thing is, I mean, in January, they just reported their latest quarter, and we're talking about like their fee related earnings. So the money that they make on the fee they charge on the money they manage for others, that was up 28%. Their distributable earnings per share was up 17.5%. They increased their dividend by 15%. So I'm like, the business is on fire and they're gathering more funds than ever. They received like more than 100 billions in inflow last year. So a lot of things to like. Yeah, the stock price goes down, but to be honest, it's not the first time that I see that from a Brookfield company where the numbers are good, but the stock is going down. So it's probably just one of those days. But yeah, so like I said, I own BN, not BAM, but I'm not really worried about this one. Definitely not. And now that it offers a yield around 4%, that could even trigger some income seeking investors to look at it. For GoEasy, though, I have a higher reserve. The thing is, this company looks good on prom night. When the economy is doing well, you can lend to pretty much anybody because anybody will have a job, they will pay back, everybody's happy. But when it starts to slow down, there is a lagging impact, right? Because the consumer is not going to stop paying his loan right away. It's going to find all kind of like strategies or solutions to drag it as long as possible before they say, hey, I cannot pay for that loan. But once it happens, it's going to go fast. So seeing GoEasy, watching them growing their loan book is not necessarily a good thing right now because it just means that people need more credit. But we kind of know why they need more credit, probably because they cannot afford what they borrow. And the other thing right now is that the provision for credit losses and the charge-off are going up. So if it's going up too fast and out of control, this is going to be a problem for GoEasy. For this one, it's going to be a little bit more of a gamble if you enter into a trade for this one. Be ready to surf that roller coaster, and maybe it's going to end badly as well. So I always preferred big Canadian banks for that reason. They're more diversified, they're more stable, and they just don't focus on being good on prom night. They are robust any day of the week.
How do you differentiate between buying opportunities and quality companies? Because you just mentioned GoEasy and like how risky it could be for many investors. So how do you differentiate between those quality companies and poor investments priced accordingly?
That is a very interesting gray area, and I'm afraid there's no clear-cut answer here. There's definitely a balance between the narrative and the numbers. So I'm always going to start with looking at the numbers first, and then trying to determine what is the portion of that negative sentiment that is related to fear, which is not necessarily going to happen, or the worst case scenario. You know, it's kind of funny because not too long ago, there was a news where, I mean, I'm a big hockey fan, and then you have like Gavin McKenna that is like expected to be the number one draft pick next year, or I mean, in the the top three. And he got into a bar fight. Definitely not a smart move. But then most media, they were saying, oh, he could get up to 20 years of prison if he's like guilty. And I'm like, guys, I mean, yeah, he's in trouble. He did a lot of stupid things getting into a bar fight. That's like the story is not looking good. But thinking that this guy's gonna do like 20 years of prison, I mean, now we're pushing it on the other side as well. So you have to be careful about that level of fear where like all hell break loose. So what I suggest is focus on companies where you have a very high knowledge of the industry and the business model. So yes, it could create some bias, of course. Like I explained why I don't think that the SaaS industry is going to be completely disrupted by AI, but I think rather that a lot of those businesses will use AI to enhance their business and become even more profitable down the road. I could be wrong, but I have a higher level of conviction in investing in something that I understand than looking at how the FDA is going to manage drugs for Zoetis, or how the American government is going to get into that fight with healthcare providers such as United Healthcare. I will feel a lot more comfortable in the tech sector or in the banking industry because I know a lot more about investment in banking because I worked in those firms for 13 years. So my level of comfort is higher there. So it's kind of like easier to get into educated guess or a gamble and that sort, instead of like just saying, oh, I've seen this company going down like for the past 52 weeks. I'm going to buy it because it sounds like a good company and it trades at price weakness. So it must be a good deal. This is a bit simplistic. So understand the reasons, try to assess if it's that important or not. And of course, going back to the numbers, if you see a company that was struggling already and then have like bad news coming after that, well, there's a good reason why the stock price, it just trades at a weak price and probably is going to continue moving forward. So this is where you can draw the line. That balance plus some level of knowledge will help you make the good decision.
So now a good place to find investment ideas is the Dividend Rockstar list, our exclusive list presenting more than 250 stocks with a positive dividend triangle. So that is again revenue, EPS, and dividend growth. You can download it for free now at thedividendguyblog.com/rockstar. Mike, is there anything you would like to add?
I mean, one thing that is is important at this point is do not load your portfolio with those kind of companies. I mean, yes, it's interesting to make a few plays like this, but if you're just focusing on companies that are free falling like this, eventually you're going to catch too many falling knives and you're going to end up cutting yourself. So always be careful about what seems to be the best deal around. Maybe it's not what it seems, since there's no free lunch in finance.
All right, so thank you, Mike, for sharing these great companies at low prices, for most of them at least. Next week, we will have a look at your 15 years of investing. So hit pause and the subscribe button underneath our podcast logo now, not to miss it. And until then, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.